Hello traders, this video is part of my series in answering questions that I get from students and sharing that with everyone. So this one says, hey Greg, first I want to thank you for your advanced technical strategies and swing courses. They've helped me immensely along with the green room, which I'll be renewing. The learning process has been great. The question involves swing trading in this market environment. I did great over the summer when the market was trending higher. Now the market isn't trending up. I can't seem to avoid getting stopped out or stopping myself out before the market does it for me. I've been taking less of them as a result and doing Dan's option trades, which have helped me make money in this environment. And what advice do you have for swing traders that are trying to make money in this market environment? Great question. So, what happens along the markets when the market is trending higher? In this chart that I have here, I've got a 20 and a 50 and a 200. 20 being the shorter MA, the 50 being equal to the 10 MA on the weekly time frame, and the 200 being equal to the 10 MA on the monthly. When the 20 is above the 50, 50 is above the 200, and the 20 and the 50 are rising. Clearly, multiple time frames are in alignment, and as prices are moving up, it becomes relatively easy for long swing trades. Now, this is a view from the top-down approach of what's happening in the broader markets, and then from there, the trades that we pick in the advisory letter are, the longs in alignment with the market environment have a high tendency to work out. So as the market is moving up and prices pull back to the rising 20 or prices pull back to areas of minor support, the odds are that they're going to keep going up until they don't, obviously. Now, using market internals and intermarket analysis, you have a pretty good idea, we have a pretty good idea as to when the market is getting to the point where it's likely to start to reverse. And we made subscribers aware of that, back here, the end of July and the beginning of August, interest rates started moving up, the dollar started moving up, and we told everybody that risk was growing. Now, when that transition happens, it isn't easy because buyers are in control and buyers don't give up so easy. Unlike sellers when things are trending down and become climactic. So during this transitional process, which you could argue the market is still in that transitional process of correcting from that point, and they haven't really reached their ultimate destination, which I believe is going to be down here in this green area, give or take. It's going to be a more difficult environment for swing trades because until they transition where they actually violate the trend and then start to turn lower, the trend is sideways and things are more erratic at those times. And long traders don't give it up right away. So they continue to buy the dip. They will get stopped out. Things will be whippy because it isn't quite obvious yet of the corrective process. So how do you avoid some of that? Well, you need an objective approach as to the change in trend, and these red dots here, when prices make a new high and then they come down to the red dot, the low prior to the higher high, that's major support, and that's when we know the trend has been violated. In addition, we know when there's been a deep retracement down toward major support, the odds are the trend is changing. So things become more erratic. Now, staying with just basic information. Where are buyers and where are sellers? Buyers are at support, sellers are at resistance. Is the trend up, down, or sideways? So here prices were transitioning from an uptrend to a downtrend. And they pop back up. And the dots to the left, that's resistance, and that's where sellers are going to be. So during a transitional process, that's where you want to look for stocks that are showing relative weakness as shorts. You always want to be selling or shorting near areas of resistance after there's been some transitional pattern. So here you had this gap up, and then prices gap down, and you get a wide range bar. And this is what we call a 1, 2, 3 continuation down. Well, you need a pattern in alignment with your bias. Now, as prices move down toward, in this case, the 200 MA, you can look at prior videos, pre-market videos, where I showed you that your internals had turned bullish down here, and you get a retracement back up. So market timing becomes essential, but you can't fall in love with those longs that might set up. And when you say Dan's option trades, those put credit spreads really have a super high tendency of working out. When you get a reversal like this, a wide range bar, and you can find stocks that are reversing like that with put spreads under support. As prices move up toward areas of resistance, unfilled gap, that declining 20 MA, you know there are going to be sellers there, and it was erratic. It was jerky until like last week it gapped down and broke the low. So your bias has to change. Hey, this is where short swing trades should work out in an area of an unfilled gap and a declining 50 MA, and then looking for patterns. So you're looking for longs near support, you're looking for shorts near resistance, and as prices begin to trend down, until it is so obvious that prices are going down almost with a vengeance like this began to, even the short trades are going to be short-lived because their buyers are still looking to take control. So as prices are going up, there's a much higher tendency for high probability swing longs, and as they transition down, you're going to find fewer trades, and they're going to tend to be more whippy. Now, what do you do as a swing trader? Well, one of the things that we do is we look at the S&P sectors. Now, what do you find here when you look at the S&P sectors? Pretty much everything is going down or sideways. So it's not an environment, well, let's say other than crude oil or energy here, which had a big move up, but that had broken down. So everything is erratic at this point in time in this environment. It won't always be this way, but that's the way it is right now. But if you stick to, hey, this is in a downtrend, as prices get extended, in this example here, and begin to reverse, put spreads, you just believe it's not a put spread, put credit spread. I just believe something's not going to go down. So what do? You see this coming down to an area of support, and you look to the left, it's in an area of support, it begins to reverse. I want to go and look in this particular sector. I click that, and now I look at stocks within that sector, and what am I going to do? I'm going to look, well, these are just wide range bars here. I can look for different scans, but I look for patterns within this sector that would have bullish bars as prices are in an area of support. And in an area of resistance, you do the same thing. So within these sectors, whichever it might be, technology is coming up to resistance. There's a reversal bar here. I come in here, and I look at stocks within that particular sector. This is called a top-down approach. What's happening in the broader markets, then go look at sectors within the markets, energy, it says financials, materials, consumer discretionary, and there are others. So we can even go down to a page like this, which I have shared with subscribers that use this platform. Top-down approach, what's happening in the broader markets. Here are the S&P sectors. Here are a lot of other ETFs where we can zero in on other sectors like software. And you can see prices are coming down. We don't have any potent reversal bars here. And we can look at stocks in the sector. So rather than opening up, clicking here, I just have a watch list over here with different scans, looking for stocks within that particular sector. And so this is just a high volume, looking for something here, and you might find a wide range bar. Here, I find something, well, that's doing nothing there, but bottoming tail bars, 1, 2, 3s, financials. Again, looking for, this is doing some of the scanning for me. and there's nothing jumping out here. This had a big volume spike that was on the way down. But a day like today, which the markets were decisively up, you can see this topping tail bar was a big green bar, and sellers took control again and pushed it back down. But if it was a big green bar at the end of the day, well, then we can look at stocks within there and find opportunities for credit spreads and at times directional. This has a bearish reversal down there, another bearish reversal, wide range bars. So the idea here is a top-down approach. The broader markets are in an uptrend. It's going to be easier for swings. And until it transitions in a very obvious way to the downside, shorts are going to be momentary and the longs are going to be momentary. You're going to have to be more active. And that's the reality of different market environments, how they change. And do you have a method for observing those changes and timing them? And that's what we do in the advisory letter. We share with subscribers that market timing and what's happening in our bias in multiple time frames, and we scan through the top-down approach to find opportunities. And at times, you just need to stand aside because there aren't super high probability opportunities. So the transports here right now, they're working their way down toward this area of support. There's no continuation pattern. So as a swing trader, just looking at this chart, there's nothing for you to do but stand aside. You have to wait. When prices get down to this support, if it forms, say, a pattern like this where there's bottoming tail bars and you get a range expansion bar, that's when it's going to be able to transition back up again. So you need to do the homework, and part of what we do at Master Trader is help you do the homework. We're doing the homework. So in the advisory letter, as I said, you get the market timing, what's happening in broader markets, the sectors, stocks within the sectors, transition, and use our market timing. We look for those opportunities. At times it's going to be more credit spreads, and other times, as things line up, it's going to be more directional opportunities. So I hope that helps. If you have any questions, email me, Greg at Master Trader.